We're coming up on 7:45. If you're an investor or have a hand in your 401k and IRA and are trying to decide whether it's a good time to buy stocks, maybe you're a first-time home buyer shopping around for a mortgage, or a business owner taking out a business loan, you'll likely be affected by decisions made by the Federal Reserve. But who are they and what exactly do they do? Financial expert Randy Waesche is joining us with a two-part series. Today we're looking at who the Fed is and what do they do. Next time you're on, we'll talk about why it's so important to all of us, because we're all affected by the Fed.
Absolutely. The Fed's influence in the monetary system in the United States is critical, and by and large, they do a very good job. So let's search back and say, who are they? And they play an incredibly important role in the U.S. economy. So what is the Federal Reserve? It's really comprised of three systems. One is the Federal Reserve Board of Governors, which provides general guidance to the Federal Reserve System, which oversees 12 Federal Reserve banks. Second is the 12 Federal Reserve banks, each of which is responsible for overseeing a specific geographical region within the United States. And third, probably the one you hear the most about, is the Federal Open Market Committee, or referred to as the FOMC, which oversees the nation's open market operations, and it makes important decisions on interest rates and the supply of the money.
And how long has the Fed been around?
The Fed's been around since 1931, I believe is the date. Excuse me, I take that back. It's been around since 1913.
And why was it so important for the Fed to be created, and what was the problem that spurred it on?
Well, it was important to create because we needed a systematized monetary system. As people went from the agrarian system, as the states and local municipalities would control all of their debts and there was runs on banks, there needed to be a more organized system for the U.S. economy to monitor the monetary system so that it could grow to the level that we've seen today from 1913.
Yeah, because we hear so much about the Fed, and exactly what does the Fed do to oversee our money?
Well, it does about four critical things. The first thing it does is the Fed sets interest rates. Now, with this, I want to be very careful, because you hear about the Fed setting interest rates. It sets the interest rates by which member banks borrow from one another on overnight deposits and or borrows from the Federal Reserve. And it gets to set that interest rate. But in doing so, it tries to influence what's going on in the economy. So as an example, back in the 70s and 80s, when we had hyperinflation, the Federal Reserve had moved the Fed funds rate up to 19.1% back in June of 1981 to curb down the inflationary pressures. Flip that into where we are today. For the past 10 years, the Federal Reserve is trying to rise interest rates, so they want to spur the economy. They're trying to get to a targeted 2% inflation rate. So it's moved down the Fed funds rate to 0.25%. Those are the swings.
And that's what keeps home mortgages so low right now.
Yes.
Credit card interest.
So low.
Credit card interest, they're in a whole different ballgame.
The other thing the Federal does is it regulates banks. They want to make sure that they are financially secure. Going back to why they were formed, this is one of the reasons they were formed. And a lot of us in New Orleans will remember, 3 or 4 years ago, the Feds actually came in and closed down the FNBC. They looked at their balance sheets, they looked at their reserves, they did stress tests, and they said, this bank's not going to make it. And they literally came in and shut the bank down.
Yeah, that was a big problem for a lot of people. All right, next time we talk, we'll talk about why the Fed is so important to all of us and how it affects our daily lives.
And it's very important. And watch what's going on in the marketplace today.
All right, thank you very much, Randy. Peyton?
Sure thing. Bye now.